interesting, especially with those multiple rate rises. Is it true that that's something that hasn't happened for some time? And also, and sort of slightly related, what's, and this is probably a basic question for you, but like, why would the variable rates be declining if the fixed rates are increasing and they're expecting interest rates to rise?
Yeah, it's a question that we kind of asked a lot of bankers, Ben, and we can't seem to get a straight answer. All it means is right here, right now, money, banks are happy to lend it out. So they're going, well, the banks didn't actually pass on a discount on the variable rate in the last, call it 18 months to 2 years. Variable rates were competitive, but the banks, when the RBA was dropping rates, the banks were lowering on the fixed rate, but not lowering on the variable rate. So, so the banks, the variable rates are somewhat now competitive compared to where they were maybe 6 months ago, 4 months ago. So to me, someone looking to be variable, okay, most people will have a blended or a split loan, so part fixed, part variable. Variable, smash down the mortgage as much as you can. Fixed, lock in a decent rate. That's the science behind it. The art is when to fix or how much to fix, for example, and that just becomes down to a cash flow model and go, right, how long do you want to fix for? How much can you actually smash off this mortgage? Right, then we just work that number out as well. And I use the word just because it really doesn't have to be overly complicated. A lot of people get stuck on that point. Right, how much are we borrowing? How much can we fix? How much can you smash down the mortgage? And let's rock and roll.
Yeah, we tend to take a pretty similar approach with that stuff, but always put a bit of a margin on top. It's like, what do you think? How much you save? Okay, you can save 50,000 a year. We're going to fix it 5 years. That's 250,000. Let's put in a buffer for your savings, and then let's add another sort of 100,000 or something on top just to give you flexibility. Because
you get a bonus, you hit you hit a stretch target for savings, you get a new role. Like 5 years is a long time. And that's what, again, I say to people, 5 years is a very long time to fix because a lot can happen in that 5 year period. What happens if you want to upgrade and sell potentially? What happens if you want to refinance to another lender? Now you're stuck in that fixed rate loan as well. So I guess that's not the dark side, that's just the other side when it comes to fixing. It locks you into that one bank, and just know that you're somewhat limited if you want to refinance and maybe pull some equity out, or your lifestyle changes for whatever reason, and now you're locked in with that one particular bank.
Totally. And it is pretty painful when you do end up in that position. I've seen a few clients there. It might be that they get an inheritance, or as you say, like a shift in careers or income, or it might be someone that works for a tech company and their share price starts doing really well, and therefore their RSUs and stock prices go up, and then you sort of up against it. And especially if that rate's on your own home, then it can be, because that debt is not deductible. It's like, it's not really debt that you want to preserve, and you're sort of backed into a corner a little bit. But that being said, I do think that fixed rates can be quite helpful, especially for people like where the market has gone up significantly, like we've seen in the recent past, and people have got these chunky mortgages that that's going to take a bit of doing to get rid of. I think though, what I've found is where a lot of people can go a little bit wrong in terms of a thinking mistake with their fixed mortgages, that they'll sort of go into a fixed mortgage thinking that they're going to outsmart the banks, or that they're going to win from an interest rate perspective over a period of time. But I've found that the reality is that the banks have got teams and teams of these propeller heads that are doing these calculations, and they're pretty cluey. That's why the banks are multi-billion-dollar.
And they're paid good money, right? The pricing teams inside banks, they're effectively running the numbers on margin, how much margin we're making on these loan products.
Exactly. But I think that what a fixed rate does give you is it gives you certainty. And I think that certainty is quite valuable. So even if you know that you're not necessarily going to win, or even if you know that you are potentially going to pay a little bit more than what you otherwise would, for people in certain situations, not necessarily for everyone, but for people in certain situations, paying a price to know that your interest rates aren't going to go up for 3 years or 5 years gives you a lot of confidence around your planning, especially, you get young families, you go through this period of lowest earning if you've got maternity leave and time out of the workforce and working part-time. And then on the other side, you've got peak spending with your daycare costs and all of the fun stuff that sits around that you go through this period where things are a bit sort of stretched. And if you want to get, and I'm a big believer of getting into the property market sooner rather than later, because we historically see things just going up. But before you start having kids, you got this bit of a window that you can, get into the market because your borrowing capacity is as high as it ever will be from a servicing perspective. But then you've got to be really smart, because it's not just how much the banks will lend you, but it's how is your ability to be able to fund and afford that, and afford a reasonable lifestyle for yourself and your family at the time of having kids as well. So I think there is a lot of value there. It's just, you're probably just not going to beat the banks. I think people should keep that
correct.
In mind.
The house always wins.
Yeah, exactly.